Hello and Happy New Year. My name is Alex Brandreth. I'm the Chief Investment Officer at Luna Investment Management. Today we're going to take a look at what 2021 has in store. Now 2020 was a year like no other, and it's important lessons that we take into 2021 with us. Clearly the fact that we've entered a new year doesn't mean everything's changed. So some things have changed. So with regards to COVID, we're in a situation, as I'm doing this at home, where we're still in lockdown, or we've gone back into lockdown 3.0. Cases are starting to increase. The number of people in hospitals and sadly the number of people dying is also increased within the UK and globally. But there are things that have changed. Brexit, this has been with us for 4.5 years. Is this now a term that we start to forget about as we move through 2021? And that has implications. And of course, in the next couple of weeks, we'll have a new US president as well. There's clearly a lot of tension in the US that's going on as I'm doing this as well. So some things have changed, some things haven't changed, but we'll cover what we think the rest of 2021 has in store. So let's just take a look at growth, and importantly, as we're doing this presentation, the UK economy is probably in recession. A recession is technically classed as 2 negative quarters of GDP. The final quarter of 2020 is likely to be negative because of the new restrictions that were placed upon us in the tiering system that was introduced at the time. And quarter one of 2021 is likely also to be a more severe recession in the end of 2020 because of the fact that we're now in lockdown, and this lockdown is likely to last longer into March, as well as that this lockdown is more severe than lockdown 2.0 was. So for various reasons, the UK economy is probably in recession. That being said, as we look forward to 2021, and importantly as the vaccine is rolled out across as well the UK and globally, that is going to lead to restrictions being eased, and gradually as 2021 progresses, life begins to go back to normal, or the old normal. And that being the case, it's expected that global GDP is going to rebound very strongly in 2021. And as you can see here from this forecast from JP Morgan, it's expected to be a record year in 2021 for global growth. You can see the different economies and how they make up. The UK will be exactly the same as this, and we'll see strong growth in the second half of the year. We already saw an example of this last year. The first half of 2020 was very weak for UK growth and for global growth, but as restrictions were eased into the summer, the economy bounced back very strongly. And one of the reasons for this is the savings ratio. Now, at the moment, we can't go out and spend. There's significant pent-up demand that's waiting to go out there. As we forecast that restrictions will be eased, we're expecting that people will start to gradually go back to the way they lived in 2019. So people will go back on holidays. People will start to have meals out in restaurants with their friends again. People will start to socialise. Things will start to get back to normal. And that's very much supported by this very strong savings ratio at 29%. Now, this has never been seen in the history of this chart, which goes all the way back to 1963. And we're not saying that savings ratios are going to go back to the levels they were in 2019, not at all. There's clearly unemployment that's going to come through, and people are still concerned about their jobs to a certain extent. But even if the saving ratio came down to a level of 10% or so, that will have a significant impact on the economy, because the UK economy, like most developed economies, is a consumption-led economy. And consumption and people going out spending really has a significant impact on driving the economy forward. And that's going to be a key driver to growth being stronger in 2021. It's not just savings ratios was increased. You've also seen loan repayments paid down quickly. Mortgage repayments have been increased and one-off mortgage payments. So the UK finances of the public sector is very strong at the moment, which means that as restrictions start to ease, life will get back to normal and have a significant impact on the economy. And let's be honest, everyone wants to go out and socialise. Everyone wants to go out and have a holiday after 2020. So there's going to be significant pent-up demand that's going to come on stream from next year. So 2021 is going to be a very strong year for economic growth, but it's likely to be very much in the second half of the year. Now, let's just take a step back and think about equity markets, because that's what we do. We think about what's going on in the economy, but also just as important, or if not more important for us, what's going on with equity markets. And this period of equity markets tends to feel quite uneasy. Equity markets are forward-looking indicators. They're looking through the current short-term weakness within the economy, and they're looking forward to the economy reopening because of vaccines and better times coming ahead. So that's why the equity market and the UK equity market actually bottomed in March of last year. So we've been in a new bull market now for 9 months. But that doesn't mean that the bull market is necessarily going over. And it's been very impressive, actually, the performance that you've seen from the FTSE 100 in the early days of January. Despite the fact that we've gone into lockdown, despite the fact that the number of cases of COVID are increasing, you've seen a very strong equity market. And that's because the equity market is looking through this short-term noise in the first quarter and really looking through to the economy reopening because of the vaccine deployment. Now, as I said, this has been a 9-month bull market already, but this chart goes all the way back to the 1900s, and it shows the different bull markets and bear markets that have come over time. And you can see that the average length of a bull market is 8 years. So being 9 months in, if we were on an average market, we're very much in the early days of this bull market. There have been bull markets that have been pretty short in the past. There's one here where it's 1.2 years, sorry. So bull markets can be pretty short in time period as well. I don't know how long this bull market is going to last, but if average is something that's going to be guiding us, then 8 years or so suggests that we could be in a very strong period for markets over the next few years. On top of that, what you can see here at the very beginning of these bull markets is very sharp increases on every single occurrence, and that is because markets are bouncing from their lows, and that's been something that we've witnessed as well. Some of the best performance in equity markets actually comes when you're in recession, but you're emerging out of recession, and that is the exact same environment that we're in at the moment. And it's for one of that and many other reasons that we're actually very positive on equities and stock market investing at the moment. So we're overweight equities within our portfolios for this reason. Now, 2020 will go down as a very bad year, but in total, it wasn't a bad year to be an investor. And there were certain areas of the market that did very well. The technology sector, the enabler in 2020, Zoom, other social media platforms, Facebook, Apple, Google, etc., all strongly benefited in that environment. As well as that, these are very cash generative, high margin businesses and very profitable, which makes them different from the price moves that you saw back in the early 2000s. So technology has been very strong. The only issue with that is that technology now, if you're looking on the right-hand side and looking at this MSCI World Growth valuation, is now very expensive. A lot of the good news has been priced into the stock price, which is why they're trading more expensive. Whereas if you're looking at this, on the bottom half of this chart, value, despite it doing well and looking more expensive, is looking significantly cheaper as a style. If you go onto the left-hand side as well, you can see that quality tends to perform very strongly in periods of stress, as you would imagine. But as you can see at the end in 2009 and in 2000 here, that people rotate away from quality as you come out of recession. And that's because people are not looking for the security anymore. They're looking for the companies that are going to survive and benefit in that environment. So yes, whilst we're positive on equities, we're not just blindly positive on everything. We actually have a slight bias for value at the moment as well. Now, this is just looking at valuations of different asset classes. On the left-hand side, you can see different government bond markets. This ranks them versus their valuation over the last 15 years, stated to the end of October, but it's still very much up to date. And you can see from this that government bonds are the most expensive they've been over the last 15 years, which is not really surprising given where interest rates are now compared to where they were over 15 years ago. And as well as that, you've seen quantitative easing, which is actually the purchase of government bonds as well. Also, as well on this chart in this blue section, you've got corporate bonds and high yield bonds. And you can see, yes, they are slightly more expensive in some areas, but they're nowhere near the expensive levels that you have in the government bond market. In this orange section here, you have the different equity markets. The UK equity market really stands out. Now, as I mentioned, for the last 4.5 years or so, we've been battling Brexit. And the UK has been unloved and shunned by overseas investors for that very fact. So the UK equity market actually stands out as a very cheap market relative to other stock markets at the moment, which is extremely interesting. And when you're looking forward to 2021, could the UK discount start to narrow versus other global markets? We certainly think so. And that's another one of the reasons that we've increased our exposure at the end of last year to UK equities. One, because the valuation is cheaper. Two, because we felt that Brexit, a trade deal will get done. And as time progresses and as 2021 unfolds, we can see that discount starting to narrow and UK equities starting to perform very strongly versus their global peers. It's not just the UK market that looks cheap relative to its last 15 years. Sterling also looks very cheap versus the last 15 years as well. So us bringing more of our equity exposure back to the UK means that we're taking profits on our overseas currency positions in dollars particularly, and bringing them back into sterling. And you've already seen sterling perform very strongly over the last year or so. Got down to below 120 to the dollar at one point last year. But as we sit here today, sterling's at 135. So you have seen sterling recover significantly in a short period of time because Brexit negotiations have progressed and ultimately been done. So just to summarise them, we are overweight equities. They look well supported as economic growth rebounds and as this new bull market that we've been in for the last 9 months continues. This also tends to be a very strong period for equity markets. The UK is unloved. Now, I mentioned on the previous page that that's led to valuations, but just anecdotally, the amount of UK fund managers that we speak to on a regular basis, and when they're presenting to overseas investors, the one question on the overseas investors' lips for the last 4.5 years is, but what about Brexit? They're not going to be asking that question anymore. So as time goes by, overseas investors will start to have more confidence in investing in the UK, which will only be a positive for sterling and also only a positive for the UK equity market as well. As a style, value could continue to bounce into the recovery. It also happens that the UK equity market does have a value bias, as does Europe. So we're expecting that to come through. So we have been targeting more value-orientated stocks. And I suppose as well as a style, value tends to be quite high dividend orientated. And in 2020, because of the economic backdrop, you saw a number of companies cancel or remove dividends. Actually, what you saw as a theme towards the end of last year, and we think continue into 2021, is that dividends came back on stream. Companies have been able to fare the pandemic relatively well and have therefore been able to reinstate dividends. We aren't positive on everything. We very much have a quality bias within our portfolios, and there's certain areas of the market that we have been avoiding. So retailers is a good example of that. Certain retailers still look challenged. Whilst we think that technology might not do as well in the short term, we really are longer term positive on that because we can't see the likes of Amazon and Netflix going backwards from here. If anything, it was accelerated the change in 2020. But property is another area that still looks vulnerable. As we shift more and more online, our offices needed, our retail outlets needed. There are challenges to face in the property market. So we're not positive on all areas of the market at the moment. We haven't even touched on interest rates. We sit here today with UK interest rates at a 326-year low for the Bank of England. It's very difficult to see how the Bank of England can take interest rates even lower. They could take them negative, but I mean, they're pretty much on the floor as it is, which means if you need to stimulate your economy, as you will do in this period, we're in lockdown because we're going to be in recession, It's more likely you see fiscal spending, grants for businesses that come through, because that's the only way that we can stimulate and support the economy in this environment. And when you see fiscal spending, it won't just be from the UK. Interest rates globally are low, in the US and Europe as well. So infrastructure is a good way of stimulating the economy, and getting, and also causing significant improvements at the same time. So we are expecting infrastructure to come through, and we added some infrastructure exposure into portfolios last year. Now, as we on fixed income, so we haven't even talked about fixed income really. Fixed income, we don't think interest rates are going to increase over the next few years, which means that yields are supported at these low levels. But the reality is government bonds now are at the lowest levels they've ever been, which makes it very hard for us to feel excited about that prospect and invest your capital or clients' capital in those investments. So fixed income is an area that we're also avoiding as well, and we went underweight fixed income when we went overweight equity market exposure. That being said, it's important we have balance. We don't want to be just fixated on the UK. We don't want to be just fixated on certain asset classes like value. We also need to build well-diversified portfolios. And that's exactly what we do at Luna. We're conscious of portfolio diversification and portfolio construction. And when you don't have fixed income, that traditional bedrock of your portfolio, you need to look for alternative areas to try and support portfolios in times of stress, whether that be gold or other asset classes. And that's exactly what we've been doing within portfolios. And that's why our alternative exposure is also larger than historically has been as well. Now, that's all for me. That was a quick update on our views on 2021. May I take this opportunity to wish you all well, hope you're all well, and to a very prosperous 2021. Thank you for your time today.